Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com will take a look at the action on the major markets this past week. Are there indications Bitcoin is about to soar again? Home ownership consultant Reaugh from the wealthyhomeowner.ca talks about inflation and who comes out ahead, a homeowner or a renter. He also explains why owing a lot on your home is not debt, but money in the bank. Cross-border tax expert Peter Ingram from Senta, Vancouver explains the tax implications of selling your home abroad and what to do if you've accidentally forgotten to declare income from a mortgage helper suite. Plus, right after the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Bob Hoye right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the Pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to This Week in Money, Bob.
Yeah, we're here.
Were the markets remarkable at all this week? Any reaction to what President Trump did in Europe?
Oh, they were whipsawing around, but today's performance would be unremarkable. The Standard & Poor's, the S&P was flat at the opening, rallied a bit, and is only up a tenth at the close, or going into the close. The bonds were down a little today, and the dollar index was a little weaker. And some of the things like gold was really beat up. It came down, and we had a technical buy on that, oversold enough. And silver has rallied. Also, crude oil, which had been a bit weak, recovered on the week. And so it was sort of net positive to the close, but only the stock market was dull. Bank stocks were unchanged. So it looks like the pressures that were on earlier in the week became a little overdone and eased, and one of the problems was that the U.S. dollar was staying quite strong. The DX, as we call it, which is, I think it's 57% of the euro weighting on it. But at any rate, going back into January, the decline in the dollar was strong. It got down to 88 and oversold. And then for an important bottom, which we thought was possible, you'd want to have the dollar trade sideways, building a base for a number of months, which it did do. And then the key to the rally in the dollar was getting above the 20-week exponential moving average, and that was on April 23rd at, I think it was 90.5 or 91. So that then, the importance, Jim, is that it replicated the low in the dollar and the base in 2014, from which a terrific rally followed. And then also of interest is it did that pattern in 2008 as crude oil was rallying up to 147, and then you had the long oversold, and then the long basing pattern, and then the breakout above the 20-week EMA. But this we have, and it's set up for a very good rally. But a few weeks ago, when it got up to 95 and a quarter, it was trading overbought. So then we figured a correction for a while. I think 92.5 was the low, and then it got back to the 95 level, and now it's down a little today, which is, as I said, giving the help to some base metal prices and gold prices and silver prices into the close.
Bob, they've seen a record buyback plan for most corporations. Has that kept the stock market afloat?
Oh, it's helped, but the market got hit so hard in January that it was due to rebound. And then also you can have the favorable May-June period, which we've had. But the stock buybacks, I'm glad you brought that one up, because this is where corporations, for a long period, a number of years before you suddenly had a strong economy, it wasn't a strong economy and earnings weren't advancing. So they invented the game whereby they reduced the number of shares outstanding, which increases your earnings per share without earnings going up. So then they were buying stocks. Now, the other thing that helped that game was long interest rates, the long-dated corporate interest rates became exceptionally low. So then it was very attractive and cheap to borrow money, and then they used the borrowed money to buy the stock market. So they're raising huge amounts of debt money and buying huge amounts of stock at very high prices. But, of course, more recently, with the changes in tax and whatnot, some of the money that U.S. companies had parked in Europe or elsewhere, it was coming back home because it was more attractive to do business back home in the U.S. So you've had that. But then I did see a story whereby, yes, guess what? Corporate treasurers are buying stock out of the market. So they're taking on obligations, interest rate obligations, which, when you borrow money, you've got to not only service the debt with interest payments, but you also have to pay it back. And then to buy the stock market at high prices. Now, certainly stock analysts are out there to take their favorite stock and make it look cheap by coming out with earnings estimates that, whether they're realizable or not, you don't know. But if you take the stock market like the S&P and compare it to GDP, which is improving, but that's a reliable indicator. The other one is you take it relative to the average wage, and those are exceptionally high. Then also another one, I saw a chart recently, was a chart of growth stocks versus the safe stocks and value stocks. That was growth versus value, and it soared up to an exceptional high in 2007, and then of course went down when growth became unfashionable or dangerous. And then now you've got that ratio back up to a high, not as high as it was in 2007, but hey, it's up there. So there are a number of impartial ways of showing that the stock market is extremely overvalued. And then the next question is what's going to happen with the underlying part, which is the financials. That you've got rising short rates, which people worry about, but we always look at it as a positive, because so long as short rates are going up, it means the boom's on. So the thing to be wary of is when like the T-bill rate starts coming down, and then you have the flattening yield curve, which again, the street is worrying about that, but so long as it's flattening, the trend is on, and all's well, the boom is on. But again, if that yield curve changes, watch out. So this is where I think it's prudent for investors to consider that the stock market is overvalued, and also to consider that it's then vulnerable, and what it is vulnerable to is its own excesses on the other side of the street, which is in the financial side, with short-dated interest rates, the yield curve, which is the difference between long-dated and short-dated interest rates, and then also vulnerable to what goes on in credit spreads, which is the difference between high-grade and low-grade bonds. And it is beginning to change on the credit spreads. It's giving an alert. It's not really made the full change yet, but it's something we would be watching very closely.
Bob, thank you so much.
Good to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Coming up, Ross Kay, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with home ownership consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, how important is the availability of mortgage credit to the buoyancy of the real estate market?
It's really important. To be quite honest with you, Jim, it's a fundamental requirement of the market. A housing market, a real estate market, could not survive if someone couldn't borrow money to purchase residential real estate, commercial real estate for that matter. So it's the availability of the mortgage credit is very important. But luckily in Canada, we have a very stable mortgage lending market. It's been stable for going on 4 decades now. There's really no concern over the availability of mortgage credit. There's really the only concern is the ability of Canadians to borrow enough money to be able to buy real estate, and that's where the problem arises. There's lots of money available. It's just whether or not Canadians are earning enough income that they can go out and borrow it.
I just saw something on the news. The city of Vancouver now says you need $150,000 a year to afford to live in that city.
That's that crazy Andy Yan at it again. So, everybody's lauding the guy out there. Look, I understand he's a young guy. I understand that he thinks he knows what he's talking about, but the latest report he did for UBC is as flawed as the one he did where he looked at people's last names and tried to decide if that was a foreign buyer rate in an area. So what I mean by that, Jim, is that Andy, when he did that foreign buyer count, he should have simply cross-referenced the names that he was using against sales in other parts of British Columbia. Now, the reason he should have done that is because then anyone who's looking to attack what he was saying couldn't bring up the racial issue. They couldn't say you're targeting Chinese people. And in all fairness, I personally think it was wrong just to use a flawed methodology to try to come up with some talking points. All he had to do was cross-references other land transfer title data on the same dates for which those, the names he was searching, purchased their new property, and he could have eliminated the ones that were already British Columbian. Those great Canadian citizens that happen to have a name, that are new immigrants that happen to have a name that he was searching for. Canadians, real Canadians. He didn't do that. So it's his own ignorance that he didn't do it, so I'll let him off the hook. It's not like he was doing something to be mean. It's not like he was doing something wrong. He just didn't have the understanding that he had the ability to do a quick cross-reference to be sure that he wasn't putting Canadians in the people that he was counting. This is the same thing with this San Francisco American comparison that he came up with that creates another false narrative for the people of British Columbia, Vancouver specifically, that they simply don't need to put up with. What he did here, Jim, was he was comparing places in the United States to Vancouver. Now, we don't even compare Vancouver against Kelowna. We don't compare Vancouver against Port Coquitlam. Did you know, Jim, that property taxes in British Columbia quadruple in other municipalities outside of Vancouver? The $1 million home buyer in certain parts of British Columbia pays 4 times the property taxes that they would pay in Vancouver, rendering any comparison of those two municipalities totally useless unless you make an adjustment for that. What Mr. Yan did in this comparison was a typical academic's mistake that he believes 3 years of myths about home ownership and affordability. What Mr. Yan should have done is he should have looked at income, net income after tax, and then he should have also looked at healthcare costs. Because in the United States of America, a homeowner to qualify for a mortgage in the United States of America has to have health insurance. In San Francisco, it costs you about $17,000 a year of after-tax income to buy that health insurance. In Vancouver, it's already included in your income tax. You don't have to pay anything extra.
We do for a year.
Well, we do for a year, but Canadians don't pay health insurance. It's covered by the aggregate of our taxpayers. You know, in the United States, if you want health care, health insurance, you got to pay for it yourself. The society is not picking up the bill for it. The greater society is not sharing the load. In Canada, we share the load. Income taxes in the United States, in San Francisco, are higher than income taxes in Vancouver. He didn't make that adjustment either. When you look at the median income of the two places, you take all of those things I just mentioned into consideration, plus if you take into consideration possibly the average family who's buying the home referred to in the survey has at least one child, and in Canada we have the child tax benefit. In the United States you don't. Then you would understand that Vancouver is cheaper to buy a house than it is in Vancouver. And the crazy numbers that he was coming up with are not comparable. It's no different than me telling someone in Vancouver that the home ownership situation, the affordability situation in Kelowna on the exact same priced home is the same. It's not. If you purchase $1 million home in Windsor, Ontario, your property taxes are 5 times greater than purchasing $1 million home in Vancouver. 5 times greater. That means you can carry an extra $125,000 worth of mortgage in Vancouver simply because of the discount in the property tax. This is where academics need to step back and be quiet because they haven't studied home ownership in the housing market for decades, and there is no research available to them to study to do so. It's why these false narratives, the misread of the data, the misrepresentation of the data, bad government policy is rooted on the ignorance that I just explained to you in 2 simple cases, citing 2 well-known studies in British Columbia.
We'll have more with Ross Kay next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Ross Kay. Ross, when mortgage lenders become fearful, do buyers then become fearful?
No, it's actually the opposite way around. It's for totally different reasons and totally different outcomes. So home buyers get fearful when they believe the housing market is going to stabilize or the housing market is going to see falling prices. What that naturally leads to is them withdrawing from the market. It's why we measure the housing market based on buyers, not on houses. Those buyers, in turn, put borrowing money because they're not getting into the housing market. So with those buyers not borrowing money, then all of a sudden the lenders get worried because their profit margins start to shrink. So the buyers lead the market. They always do. They always will. There is no other alternative. Lenders, they make their policies based on how buyers are acting in the market. So when buyers become fearful of falling house prices and they stop buying, mortgage lenders become fearful of lower profit.
Are financial institutions starting to constrict credit?
The constrict credit myth has been out there for a very long time, and it was part of the reason that the American housing bubble, the explanations in the first couple of years were subsequently proven wrong about the subprime lending crisis. There's enough economic data available now that has been fully debunked. And in all fairness, Jim, our own research, we could have debunked this within 2 or 3 months of the financial crisis starting in the United States. Financial institutions lose money when they constrict credit. In the country of Canada, the greatest home ownership environment in the world, the rules and regulations that have been established over decades, practices that have been followed by Canadian homeowners for decades, mean that the banks never have to change their attitude about lending mortgage money. Now, if we're talking about consumer credit, yes, there will be a small difference with that, because on falling home prices or a housing market where home prices are not escalating, financial institutions get a little bit worried about credit card debt, about car loan, or any debt that is unsecured against Canadian residential real estate. Your listeners need to understand how the housing market goes in Canada is how Canada goes. It is impossible at this time for the foreseeable future, meaning at least the next 10 years, from the Canadian economy to divest itself from its reliance on the Canadian housing market. We should be embracing the fact that everyone in the world wants to come and live in this great country, and we should use the next 10 years to get out of the mess we're in.
We'll have more with Ross Kay right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Reaugh shear zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Ross Kay. Ross, is the demand for mortgage borrowing decreasing?
Great question. Mortgage borrowing has been decreasing since the fourth quarter of 2016. Now, you're not going to read that in any government-produced documents, any of the bank charts, anywhere else. But the demand for mortgage borrowing decreases ahead of the actual mortgage money beginning to be recorded as being decreasing. A housing market slows the demand months and months and months ahead of it being recorded in any statistic. You have to be measuring a housing market months in advance to understand how the market is going to be functioning months later. That's why when we make the comment, has demand for mortgage borrowing been decreasing? We say yes, since the fall of 2016. It began to be registered almost 12 months later, it was only in early 2018, a year and a half later, that the banks started to be complaining about it, the government started to brag about it, and the reciprocal changes to the mortgage lending discount started to take place. And we have seen a volatile mortgage discount market in the spring of, since January 18 till July of 2018, simply because of that decreased borrowing being recorded on falling demand from over 18 months.
Are Vancouver, Toronto, and the rest of Canada likely to see real estate pain ahead?
It depends what perspective you're looking from, Jim. If you are a Canadian who is not going to sell their home in the next 15 years, then I will say, no, it won't be painful. You may think it's painful, but actually it will be the antidote to the pain that you really would be feeling if a correcting market didn't happen. Because the vast majority of Canadians are still working their way up the property ladder, not down it. It's only the boomers that are even considering starting to work their way down the property ladder. Now, it's when a market is correcting, the only people hurt is actually the people that are working their way down the property ladder, or people who've lived in their houses for decades, 20, 25 years, paid off their mortgages, and they've been using their house as a way to fund business or a lifestyle. Those people will feel the pain. But that segment of the home ownership market, Jim, is very small, less than 15%. So 85% of Canada benefits in a correcting housing market. It's just that no one wants to explain it to them because you can't make money off. The banks don't want the housing market to slow and prices to drop because they want you to have bigger mortgage. Real estate agents want to have bigger commissions from selling more expensive homes. We're Canadians, that 85% that I was talking about, who still are working their way up the property ladder, the less amount of money that they have to borrow to buy the real estate, the home that they want to own, the better off they are. So the pain that is ahead will be for such a small percentage of the Canadian public. The overall correcting market, even though people don't want to hear this, is good for everyone.
Is the coming real estate downturn likely to be less severe than the 2008 credit crisis?
No, that's impossible. So a quick answer. In early 2009, the Canadian Mr. Flaherty, then the finance minister, smartly made the decision to lower interest rates to try to get the housing market back on track. In the way that the Canadian housing market is structured, because it's totally different than the United States, and I'm going to use the term home trading infrastructure. Canadian home trading infrastructure is totally different than the USA home trading infrastructure. Mr. Flaherty was able to pull levers very quickly, which Canadians reacted to, and it staved off Canada entering the credit crisis that the United States entered. We had a very short term. If you go back and you look at what economists are referring to in the recession of that time, it was very short-lived. CMHC, if you go to their website, you look up for the latest Ontario Housing Market Insight Report. They cite this in the report. They mistakenly cite it, but they still cite it. So it is not going to be less severe. I'm going to say that what we went through in 2008 in the real estate market was nothing. It was a blip. It was a little tiny change. The big question is this going to be like the 1990s in Canada? Is this correction going to be a true correction? And barring falling interest rates, and you've got to remember, Jim, even if the Bank of Canada reverses and drops rates, there's only 1% to zero now. There's no room to move. It's not like it was back in 2008. It's not like it was in 1990. So it is not going to be less severe. It's going to be just the opposite, and it already is.
How could Vancouver, Toronto, and the rest of Canada avoid a housing collapse?
Oh, a simple question that everybody's going to hate. Don't buy a house. That's the easy question, Jim. If people don't purchase residential real estate, it means housing prices will not go up and they won't go down. They're going to stay what they were the last day houses were bought. Now, unfortunately, or fortunately, that's not what's going to happen. People will continue to buy houses. If they're not buying them in enough volume, and then they're not buying them at a rapid enough rate, prices fall. If they're buying them at too rapid of a rate, prices inflate. This is how housing markets function. It's how they have to function. If your question to me was, Ross, after this collapse has taken place, how can a government, the Canadian government, prevent the next housing bubble from forming? The answer is quite simple. You lend mortgage loans based on the value of the property a year before. What that means is when a home buyer is purchasing a property, they can only borrow money based on what that home was worth the previous year. If the house has gone up 10% in value, they have to come up with an extra 10% down payment. This makes it impossible for a housing bubble to form no matter what happens with interest rates. It is the only way that you can prevent a housing bubble from forming. The only problem you have is that no one understands this because the people directing policy haven't worked with thousands and thousands of home buyers, homeowners over decades. They don't understand how the property ladder works. They don't understand how people buy and pay for their homes. They don't understand what I'm talking about. The simple solution is to prevent a future housing bubble from forming, you only lend money, mortgage loan money, based on a home's value from the previous year.
How big is the household debt in Canada, and how does it break down? Mortgages, auto loans, credit cards, and so on.
Well, we're around the $2 trillion mark in terms of household debt. I mean, these are well published numbers. Every newbie economist has these sort of numbers. The mortgage market makes up about 3/4 of that. Auto loans, credit cards make up the rest. The household debt is never a problem. So this is one of the biggest myths that's out there in the marketplace. What is the problem is that the lack of understanding about mortgage debt and how Canadians interact. Canadians interact with mortgage debt the same way that they have for the last 40 years. That assurity means that the housing market technically can continue to survive even with housing prices that are falling, because mortgage debt will have to increase. So net mortgage debt in Canada will have to increase even if housing prices are falling. Economists don't like to talk about this. The Bank of Canada won't want to talk about this. The politicians will never talk about this. Our finance ministers will never talk about this. You cannot have a housing market if you don't have new mortgage debt being added. Even at the lowest mortgage rates in history, in a country like Canada, where the Minister of Finance reduced the amortization period down to 25 years for mortgage loans, Canadians cannot pay off household mortgage debt quickly enough that in a slowing housing market, even in a slowing housing market, that debt can't grow. When that debt doesn't grow, this country is in major problem.
With debt inflation outpacing wage inflation and credit constricting, what will happen to deeply indebted people?
I love the inflation question here. I absolutely love the inflation question because it is so misunderstood by economists, academics, analysts, everyone. So we look, inflation is very, very important to my understanding of a housing market. What I mean by that is that I know that Americans, because they can get a 30-year term mortgage, are making the biggest mistake of their life by not buying a home. Now, Ross, what are you talking about? What I'm talking about is this. Let's say in the United States, I can go out and purchase a home with a 30-year term mortgage, meaning if I'm required to make a $1,000 a month payment, I am going to have that same $1,000 a month payment for the next 30 years, and when I make my last payment, my mortgage will be paid off. In Canada, we don't have that option. In Canada, the longest term that you can take out a mortgage is 10 years, the longest term. In other words, my $1,000 mortgage payment can only be guaranteed for 10 years. Most Canadians take it out, they only guarantee that payment for 5 years. And this is where the power of inflation differentiates home ownership from renting and from even the shelter costs that governments paid it for the homeless.
So, Ross, what is the real inflation rate out there, and what can the average homeowner do about it?
Well, if you're an owner, I mean, you're totally different than a renter, Jim. And this is something that people don't talk about when they get into this should I rent, should I own scenario. As I said earlier, if you're in the United States, this is a no-brainer. This is a no-brainer. If I'm going to make a $1,000 mortgage payment for 30 years, I know that with each passing year, the inflation-adjusted value of that mortgage payment is going to decrease. And it's going to decrease crazy. In Canada, because you can only get a 10-year term on a mortgage, at least a homeowner gets that 10-year window of watching as their real house payment decrease. In other words, inflation is going to offset a portion of your mortgage payment every single year. Renters, it's just the opposite, Jim. For renters, you should expect your rent to increase with inflation. Now, you're not going to read this in any textbook. You're not going to go out and find this, as of today, posted on anyone's comparison of rent to own chart. You're not even going to see it discussed because they don't know how it works. They have never thought about it. We do. We know that with a 10-year mortgage, where the mortgage payment is identical for all 10 years, by the end of the 10th year, you have about a 23% reduction in the real payments you're making if inflation only is at 2% for each one of those years. Your listeners need to understand this. Inflation is the friend of the homeowner. Inflation is the friend of the homeowner. Inflation is the enemy of the tenant. Inflation is the enemy of the tenant. This is a black and white, numbers-driven answer. Inflation is great. The higher the inflation rate, the greater it is for a homeowner. Even if the value of your home is dropping in high inflationary time, you are winning because your mortgage payment is decreasing every single year, that inflation increase. Take that into consideration. When people are talking about inflation, credit, debt, you need to look at it from a real world perspective, not from this. I don't even know how to explain the fact that this simple fact doesn't appear anywhere on the internet today, Jim. I can't explain.
Well, Ross, look, at some point you have your mortgage you don't pay any more mortgage, but your rent never ends and it always increases.
Right, but you still have to do a mathematical calculation, Jim. I mean, to win the argument one way or the other, you still need to do real math. The rent, even if the house price stays flat. So for 30 years, your house didn't increase in value. If the owner of that house had rented it out, I can tell you his rent over 30 years is going to increase with inflation every single year, because in a market like that, the home ownership rate is going to stay heavily weighted towards rentals. So he has no problem finding a tenant. On the flip side, the owner of the person who buys the house and lives in it themselves, they've got 30 years of falling real world, real wage adjusted, inflation adjusted house price. It's actually falling every single year. So at the end of the 30 years or 25 years in Canada, yeah, your mortgage is paid off, like you said. Ross, you got no more payment. That's correct. If you're renting, you're going to continue that payment. That's correct. But if I own a house, Jim, in all fairness, I also have maybe, well, if it's today, the average Canadian's got over, $500,000 of equity tied up in their home. So there is a cost to that equity sitting there not being used or growing. And this is where you need to go back to that 6% rate and calculate. That said, if your listeners out there who are striving to search for information take this one grain of information from today's broadcast, is that the homeowner benefits from inflation, the tenant is harmed by inflation.
Okay, Ross, let's get into the lightning round of questions here. How much mortgage debt is backed by CMHC, and how much are the financial institutions on the hook for?
Oh, so in terms of how much mortgage debt is backed by CMHC, in all fairness, Jim, it's probably around 50%. The charts that they show you don't reveal that, but if you understand how mortgage default insurance works and how long it stays in place and how the banks use it quietly in the backside for their mortgage books. That's probably what the case is. How much are financial institutions in the hook? As I have said on our regular podcast, Jim, the banks are on the hook for nothing. They have nothing. It's so minor, it's ridiculous. Canadian homeowners, they're the ones who are on the hook. They're the ones who take the hit. We can take a 30% house price correction in Canada. Well, it can probably go 35% right now, Jim, and there is no risk for the bank. The only risk, all of the expense will be borne by Canadian homeowners.
Are some Canadian financial institutions in better shape than others to survive dropping real estate markets?
Yeah, certainly. Banks, financial institutions who rely disproportionately on their mortgage book to drive profits will be harmed more than banks that don't. In other words, banks that are deriving a higher percentage of their income from other sources, wealth management, trading stocks, savings accounts, whatever they're doing. The banks that have the largest mortgage books always have a tougher time in a correcting housing market. And we're seeing that take place. We're seeing the consequence of that in the last couple of weeks. The Bank of Canada raised rates by 0.25%. What you didn't see the mortgage qualifying rate increase by 0.25 point because Canadian banks didn't increase their 5-year rate. They're using the B20 rules to their advantage. At the same time, discounted 5-year rates drop. The banks are fighting to get your mortgages. They're fighting at the most fighting that they've done since 2013. That was fully expected, as we've said on the show previously. You just have to know where the mortgages are going to be booked, what banks are going to be looking to get that business, and what they're willing to do or who they're willing to manipulate to get that business.
What percentage of a property's value do financial institutions lend out as HELOCs? Home equity loans?
Generally, Jim, they're around 60%, but they can go as high as 8%. Now, I say generally is your listeners should understand when you look at a reverse mortgage, the terms that reverse mortgage companies will lend under, those are generally the type of terms that banks want to stick to with their HELOCs. So if a reverse mortgage, you can borrow 55% of your house's value. That's generally what the banks want to do with their HELOC. If they go higher than that, then what they'll do is they'll put portfolio insurance on it, and they will not tell you that's going to happen. They will just simply charge you a high enough extra interest rate to make up that payment that they're making to CMHC.
HELOCs are not covered by the Canadian or by CMHC, so is 100% of the loan risk on the financial institutions, or do they sell off the debt paper to somebody else?
Okay, so the HELOCs that are not covered by CMHC, yes, they'll be bundled and they will be sold to investors, or the savings accounts of the people that use that bank will be used to fund those HELOCs. The vast majority of HELOCs, though, are covered by CMHC. They're covered quietly through portfolio insurance is what the term is. The banks don't talk about it. There is a certain limit that CMHC sets every year and assigns to each bank. So the banks max out these amounts with CMHC. They don't just put it up. They don't give some flexibility. They push it right to the wall because it's such a good deal. And that's why CMHC effectively does cover any risky HELOCs in Canada today with a major financial institution.
Ross, is this a good or bad time to be an independent mortgage broker?
Okay, so I'm going to give a new term here for mortgage brokers for those that are listening, Jim. It depends whether you're a legacy mortgage broker or you are not a legacy mortgage broker. So just like real estate brokerages, legacy real estate brokerages, all the ones that you see out there today, their days are numbered. It is a bad time. It's a bad time in terms of there is so much legacy garbage hanging around their necks that they're not going to be able to get away from it. The mortgage brokers are exactly the same. The mortgage brokers who are earning their money on commission and haven't disclosed those commissions, or have kind of disclosed those commissions, or who have led their clients to make a decision so they get a higher commission, and the hundreds of other scenarios, just like real estate. They're in big trouble because they're not being paid for advice. They're being paid on commission. So your independent mortgage broker, who is not gaining their income from simply giving advice, they're getting their income in the same way mortgage brokers have for decades, which is commissions on the mortgage product that they're securing. Their business model is over. It's done. The consumer today, with today's technology, with online accounts, access to these sort of mortgage funds, are no longer need. They're going to be able to check 50, 60 different prices online and make a decision, click a button, and book it. Where the mortgage broker is needed, and I mean needed. They need to be paid for this. They need to be tracking the mortgage market all the time, all the options that the lenders have, all the risk that a consumer has when using a particular mortgage, the advantages of one mortgage or another, the flexibility of one mortgage or another, how the interest rate profile of the lender changes over time, and they need to communicate that with their client. And the client then will happily pay an ongoing fee for that sort of advice. The mortgage broker can make more money with that model than he could trying to strike out commissions from a bank. Exactly the same as the real estate business. The days of commission-based sales are over. It is over. As this market corrects, with technology the way it is today, with the consumer available to do simple fact check with Google. In other words, what my real estate agent told me 5 years ago, I can find out now what he was saying was not true, is going to wipe out these industries. This isn't like 2000 when all these industries thought they were going to be wiped out by technology. This is where the consumer has reached a point where instantaneously they find out the advice they're being given is to generate a commission and not to help them out. You can't do both. I promise you, Jim. Because I had this discussion with my dad just a couple of weeks ago, and I was saying, Dad, it's hard for these real estate agents to tell people not to buy. And he looked at me and said, well, if they don't tell somebody to buy a house, Ross, they'll be out of business. They'll be broke. They won't make their mortgage payment. Of course they're going to tell you to buy a house. Now, my dad, of course, sold thousands of houses. So he knows that that's just the reality. Those days are over. As we come out of this correction, you're going to see totally different new models for the mortgage brokerage business.
Is this sort of why the reason bank branches are being phased out?
Yeah. Now, so again, this is so cyclical to me. This is not something that's new. I watched bank branches get phased out in the early 1990s. They were being built until the housing market turned over. Then all of a sudden they were starting to disappear. Banks were actually selling prime real estate to get money to offset the losses that they were having from shrinking mortgage books in the early 1990s. You look at, there's great, beautiful bank buildings all over Canada that are no longer owned by banks.
Yeah, they're Tim Hortons now.
Yes.
I'm not kidding. Yeah.
Right. That was the last housing correction. Okay? So here we are today. In the last 10 years, 15 years, banks all of a sudden started building branches again. Many plazas have standalone banks that were built on those plaza footprint where the bank entered a 25 to 40-year lease for that building. They don't even own that building.
Ross, do you think Canadian bank stocks are likely to appreciate from here?
Yes, Canadian bank stocks probably will appreciate, but I'm the wrong guy to ask. Do not believe what I just said.
Okay.
What I can tell you is that their money that the bank makes from their mortgage book will not grow the way it has over the last 5 years. That's what I can tell you. Get your bank advice from somebody else.
Does it look like all of Canada or just specific provinces could be headed for recession?
Outside of the oil-producing provinces, which could get a boost if oil prices head back up again, this will be a national house price correction. There's no way around it.
What is title insurance and how important is it?
It is so important that every single home buyer in Canada should get it. There have been recent Canadian Supreme Court decisions that make title insurance even a greater value today than what it is. I expect the cost of title insurance is going to go up because of the decisions that were handed down by the Supreme Court, making that title insurance so awesome for a home buyer. So title insurance simply ensures that on the day that you move in, the property is exactly what you thought it was and that you own exactly exactly what you thought you were going to own. If there is a stake that is in the wrong place, a fence that is in the wrong place, and all of a sudden your property decreases by a foot because you find out the neighbor says, oh no, that was my property, the fence was put on my side of the property and you didn't know any better, and the paperwork said that you did own it, title insurance will pay you for that. Title insurance pays for a whole bunch of things, and for the small price that you have to pay for it, virtually every real estate lawyer in Canada today is recommending it.
Ross, how can people find out more about the Wealthy Homeowner?
Well, it's the wealthyhomeowner.ca, our real estate consulting firm, rossk.com. But for your average listener out there, Jim, they should head over to the wealthyhomeowner.ca and have a look.
Ross, thank you so much for being on the show.
Thanks for having me on the show, Jim.
We'll be chatting more about real estate and taxes with Peter Ingram next on This Week in Money.
AMY Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abunresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.TSX.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Peter Ingram. He's a cross-border tax expert with Senta in Vancouver. His website, Senta.com. Welcome to This Week in Money, Peter.
Hello.
The real estate tax burden in Canada and the U.S. First, let's take a look at Canada. How long do you need to live in a primary residence to qualify for the tax-free capital gain?
Well, when you purchase a home, say it's your first home, it immediately qualifies for the primary residence exemption. Ideally, you have to be ordinarily inhabited into the home, so the date of move into it constitutes that. So right away.
If you live in your primary residence for a shorter period of time, then what you said, are you taxed on any profit, and can you claim any loss?
Well, when it's one primary residence and you're an average person, and say you move into a home, and 8 months later you want to sell it because something else dangled down the street, and you think you're going to be happier there, you sell and you move forward. Both homes are going to be eligible for the primary residence exemption, and this is because the government allows you to purchase and sell a home in the year and reacquire another primary residence exempt home during that period. They don't want you penalized for the couple of months that are a layover. To better understand the rule, we'll explain a little bit later here, but a shorter period of time, if you're not flipping a home and you're just an average person moving into a home, no, the period of time doesn't matter as long as you're only designating one property during that year as tax-free.
When you sell your primary residence, is it tax-exempt regardless of profit or loss?
It is. So a primary residence is not eligible to claim a loss against your taxes. So a capital gain being tax-free, the capital loss is being unclaimable. If there was a portion of the primary residence that was taxable, to be determined later, there could be a portion of a loss that could be claimed. But ideally, 100% primary residence home is either tax-exempt or capital loss exempt as well.
How many primary residences can people sell in their lifetime utilizing the tax-free capital gain?
In a perfect world, one a year, because you're allowed to purchase and move into and sell. The golden rule is there's one home eligible per year for a primary residence exemption. So if you you always buy and sell and move on and don't own two at the same time, technically, as long as there's only one sell a year, you could sell one every year and remain tax-free.
Peter, how many years can the Canadian Revenue Agency go back to see if people actually qualified for the tax-free capital gain?
Well, this is going to depend if people have filed a tax return or not. Now, there's a couple different statute of limitations and attachments for years the government can come back and assess a filed tax return, with the golden rule being about 3. So if you filed a tax return, the government has to come back and open an assessment within 3 years. Unless they can prove fraud, then they can open it up indefinitely. So it's a little bit sticky right now. We've got the Property Transfer Office about 3 years behind in their information giving to the government. So the government has created some changes to the tax return over the last 2 years to try to catch the people selling multiple homes. And because of this seller frenzy in the GVRD, people selling multiple homes and the property flipping. Now, when one house gets sold, quite a few times, the shadow flipping is not in the contract. The contract really only goes to the office once, so it's very hard for the CRA to track down all the individual bits in between the first party on the contract and the final party that it's being sold to. So they're still having problems trying to figure out the paperwork in between, but that's why they're trying to prevent the flipping. When the CRA, how many years can they go back? If you filed a tax return in the 3 years, if you haven't, it's pretty much indefinite, but they'd have to open up a court case and be able to prove fraud, that you totally knew what you were doing and failed to do it. Most people don't fall under the fraud in a court case, but you always have the opportunity to come forward and file a tax return, late or amended. Now, if a tax return's late, for instance, you're a non-resident in Canada, you sold a home, you pretended to be a resident, there's going to be some stiff late penalties attached, but the tax is going to be as it is or would have been, plus a penalty and interest as well. If you filed a tax return as a resident, failed to report that income, decided that, you had some bad advice, you want to come forward, either using something like the voluntary compliance or voluntary disclosure program, where you say, hey, I didn't really know, I want a lesser penalty, can we bring this forward? Or just a straight amendment to your tax return. Every Canadian and American, albeit, has the right to amend a tax return to include income they previously failed to report. In that case, you'd add in the income, you'd owe some tax, and the CRA would only attach an interest as if it was due during that period. And because you filed a tax return on time, there's no stiff late penalties or attachments. It's only interest to get it caught up. So it's a very good situation to be in terms of getting caught up in terms of the nightmares that we see day to day.
Peter, if someone owns a number of homes, can they sell one per year and claim that each home was their primary residence?
I'm going to answer that quickly. No, they cannot. To best understand the primary residence exemption, only one home can ever be designated during a year. So you got to put all your home ownerships onto a timeline. Say you've owned one home for 10 years, one home for 5 years, and one home for 2 years. So right now you've got 3 homes. You want to sell your home that you've been living in for 10 years. That might have been tax-free for the whole period. You've lived in it, you've inhabited it, you haven't rented it, you acquired 2 other properties. Maybe you let children live in them, maybe you rented them out. But for that whole 10-year period, that first home you purchased, hopefully it's got the higher value and growth, would be considered the primary residence. Thus, once sold, every other year that you own the other 2 properties will be ineligible for the primary residence exemption. Now, if one of those homes is ordinarily inhabited by yourself, a spouse, a family member, a child, they can be considered tax-free once you sell your other home, because you're no longer having a home that's primary designated. So you end up working out a calculation. The government wants you to fill out a form called a T2091, Principal Residence Designation, and it works out a worksheet where it asks how many years are you designating this home as tax-free, how many years have you owned the home, and by dividing the tax-free years over the total years owned, you get a rough estimate of the tax-free percentage. Vice versa, the taxable years that were owned over the total years owned gives you a rough estimate of the taxable percentage. Now, the government equation also has a +1 add in there, which complicates things, but not worth really discussing in terms of the rough equation there. So you get people that conflict both the U.S. and Canada. They think, well, I can own multiple homes, and once I sell one as a primary residence, I can move into my next one, live there for a year, and then call it my primary residence. But in truth, both homes have been owned for quite a few years. One has already claimed the eligible years, and one is ineligible to have claimed some of those years. So the government is trying really hard to come back, to use the Property Transfer Office, to get all the information. They've established a special department. They've now got you to have a disclosure on your Canadian tax return yearly to ask whether or not you have sold a primary residence, and if you have, to now fill out that T2091. And because it was not on past tax returns, the government really had to use the Property Transfer Office to attain the information available. So now that it's going into tax returns, it's hopefully going to help clean up the mess a little bit.
When foreign home buyers sell a property in Canada at a profit, how does the Canadian Revenue Agency collect the capital gains tax?
Well, anybody that's sold a home or purchased a home in Canada knows that the contract, usually that you look at, has a question that asks if the seller is a resident or a non-resident. Now, what I find, because I specialize in foreign property sales for non-residents in both Canada and the U.S., is that realtors are always far too quick to not fill out that box correctly. So I'm constantly have Canadian non-residents living abroad who have homes left in Canada that come back to sell them, even though they've been in places like Saudi Arabia for 5 years. And the realtor allows them to sell it as a resident. Now that's, just wrong, and there's too many things going wrong like that. But when it comes to what you're supposed to do, that foreigner is supposed to go through a non-resident property sale procedure that involves filing a T2062, which is a certificate of compliance, which basically says that the CRA wants to know how much the gain is of the property. Now, if you don't let them know how much the gain is of the property, I mean the taxable gain, they're going to try to withhold 25% of the full sale value of the home. So for an easy number, you're selling your home in Vancouver for $1 million, you're a foreigner, you don't live in Canada, you're not a resident, the government's going to try to collect $250,000 from that sale price and put it in a withholding account. Now everybody goes, whoa, I don't want to lose 25% of the full $1 million. I bought the home for $900,000. I only made $100,000 capital gains. So you do this T2062 to inform them that the purchase price was $900,000, the sale price was $1 million, and the gain of the property is only $100,000. And it allows that $250,000 withholding to be reduced down to $25,000. The lawyer still has to hold all $250,000 while the government makes this assessment, processes it through the time. It can take anywhere from 6 weeks to, I've had horror stories of 1.5 years of the government arguing through specific paperwork to verify prices and whatnot. But in essence, it's about 6 weeks to 3 months to get that certificate of compliance approved. Once that 25% withholding is paid to the government issues that T2068, which is the actual form that gives you about 4 copies, one for yourself, one for the purchaser, 2 for you in terms of your tax return, and it issues that withholding much like an employment T4 with your wages and shows the withholding that you attach to your tax return. When you file the next year, because that property has sold, the government wants you to file a tax return as a non-resident for the Canadian property sale, and by taking that security of 25%, well, they really create a reason that you should file. You file that tax return, the taxable capital gains gets lowered from $100,000 to $50,000 because of the 50% taxable rule in Canada. The $25,000 withheld goes against $50,000 income. Now, tax rates on $50,000 are not 50%, so it creates a huge refund. You also get the opportunity to tack in your realtor fees, any expenses concerning the sale, any improvements, adjustments to the capital cost base, And you can effectively, reduce that withholding and create quite a substantial refund on every property sale return. So it's a couple of steps that are often missed. If the non-resident sells it, pretends to be a resident, there's no withholding. They might not file a tax return. The Canadian government doesn't even have a trigger to have this person file. So there's an easy step missed. And then it comes down to the property transfer office from divulging the personal information from the sale, and the government sends out letters that might never go answered. So it's a sticky situation that they're doing their best to try to attack.
Shadow flipping in the Vancouver real estate market was in the headlines a couple of years ago. Was each shadow flip a taxable transaction?
Well, I'd like to say yes. The problem is how to trigger it. So a shadow flip, if you're a Canadian, a flipping, the government's got a couple portfolios. They consider property flipping people, including real estate agents, who buy and resell homes in a short period for a profit and are engaged in property flipping. There are three main categories of people engaged in this: professional contractors and renovators, speculators, and individual renovators. The CRA acquires and analyzes third-party data and has found that some flips are not being reported or are being reported incorrectly. The profits from flipping real estate are generally considered to be fully taxable as business income. Now, the facts of each case determine whether such profits should be reported as business income or as a capital gain. Now, I kind of like those last two sentences because if you're a Canadian resident, self-employment business income is fully taxable on a T2125 or a self-employment schedule. But if you're a non-resident in a country with a treaty with Canada, self-employment, if you never set foot in Canada and you're only dealing with these types of contracts internationally, you might not be subject to Canadian taxation on any of that business income. Now, if the government takes a look at this and wants to deem it as capital gains, well, then the non-residents would have to go through T2062 procedures for each shadow flip. But if they're generally considered to be taxable business income, then it's easy for a non-resident to never be taxable on this, whereas a Canadian person would be. Now, with shadow flipping and business income, if it was taxed properly, you'd be able to, claim your expenses, business-related, home office, other bits and pieces to help limit down that income. But, a lot of people haven't been reporting that. A lot of the reason why they haven't been reporting that is because through the shadow flips, there's a lot of names that never meet the legal paperwork. The government only gets the legal paperwork, so it becomes this misleading area of lack of information that's allowing this type of market to exist.
If the shadow flipper was a foreigner located offshore, who's responsible for any taxes owing on each shadow flip?
Well, this becomes much like I attempted to answer there. The shadow flipper was a foreigner. If the government allows it to be business income, it wouldn't be taxable in Canada. But if they deemed it to be capital gain in nature, then they would be subject to the non-resident taxes as a capital gain, much like if it was just a regular property sale. But without the information available, it's hard for them to track down. So we then begin to look into residency, and a lot of things I deal with in terms of residency is how do you establish residency? Residency has nothing to do with citizenship either. You can be a Canadian living in abroad and still own and sell and buy and sell property in Canada and not trigger a residency issue. But, it comes down to people who are foreigners that aren't Canadian with no attachments in the Canadian system that are involved in this. And it's just how are they coming forward properly, or even why would they? So if it's business income and they're confident with that, most of these people would never even have to file a Canadian tax return.
We'll have more with Peter Ingram next on This Week in Money.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with Peter Ingram. Peter, if you rent out your basement suite, does the full primary residence tax-free capital gain apply?
Well, this is a good one. Most people love to have a basement suite these days. The little income earner, it helps them qualify for the mortgages, and it's one of the things that you kind of have to survive in this property market in the Lower Mainland. But as long as you don't depreciate the value of your home, I'll explain that quickly. Your home is worth a value, and there's a portion of the building that is per se depreciable, and land value, which is never depreciable. Depreciable means that the government says over the lifetime of the home it's got an adequate value, and it goes down a little bit each year. The United States is 27.5-year golden rule, so the value of your home is going to become kind of zero after the end of 27.5 years. Whereas Canada just takes a piece every year. But if you don't want to depreciate on your primary residence, so we'll go back a minute to qualify for a primary residence, you can never have depreciated your property. So people that have a basement suite should never depreciate the building value. Don't ever let a tax accountant ask you what your building value is. Put the figures in the tax return, because that could easily remove the primary residence exemption eligibility. Huge mistake. Please don't let it happen. So when you do sell your home with the basement suite and you have not depreciated your property, your home is still eligible 100% for the primary residence exemption.
If you rent out your home or part of your home for a number of years, then live in it without renters for a year prior to selling it, does the full primary residence tax-free capital gain apply?
Yes, again, as long as it's not depreciated.
What is likely to happen if I rent my home or part of my home and do not report the income?
This is really, really common, both with foreign students and, Airbnb becoming more common, and just people that aren't aware of all the paperwork reporting, or think that, hey, my mortgage interest is so high, the income's going to net out to zero, so why even bother putting it on? Well, the government says any income you earn has to be reported on your tax return. We're in a worldwide income country. You have to report your income that you receive. And then it's your option or benefit to claim expenses. So as long as you're part of the home, or your home is being rented out for fair market value, not to a family member for expenses only, you can claim the expenses. And if they're more than the income earned, you might even get a taxable loss attached to your tax return, which could benefit if you've got a regular income. You'll end up getting a larger refund. If you fail to report the income for many years, and say you've been filing a regular return on time, much like I talked about earlier, as long as you are amending a tax return to be accurate after the fact because you found out information that you should have done, and you attach that into your tax return, all the government's going to do is charge you an interest. There's going to be no penalties because you filed on time. If you haven't filed on time and we're in a delinquent situation, you're going to owe money. They can attach, up to 27.5% penalty and interest on the taxes due. It's much nicer as long as you've been filing yearly and your tax return has been filed on time. It is very disappointing to have a taxpayer in the office and be filing late and find out that they owed taxes and get structured into that fine and the penalty versus being able to file on time. So I like to say to everybody, as long as you file on time, the government has a very polite interest rate of about 4.5–5%. If you file late, there's penalties and aggressive interest up to 27.5%. The government is very fair. They're like a cheap line of credit. You can owe them money, you can make a monthly payment, 4% interest rate. File on time, owe the government money. Don't avoid owing the money and filing. It's a much nastier situation to be in.
How many years can the Canadian Revenue Agency go back to look for unreported rental income?
Well, the golden simple rule is going to be if you filed your tax return 3 years. If they can prove fraud, it can be indefinite. So it's a sticky thing, whereas we're not trying to escape the 3-year rule. We don't think, well, I'm going to go that 3 years and maybe they won't. It becomes pretty evident in communications and whatnot that could constitute a fraud report. So it's good to understand that the government can go back indefinitely for unreported income.
If people have not reported rental income, should they be proactive in reporting it now?
Yeah, absolutely. Again, if your tax return has been filed on time, haven't filed the rental income, be proactive before the government sends you a red flag. All they will is assess is an interest to the amount owed. The taxes due would have been just as if you had filed them on time with your regular tax return, and it's got to be the easiest process to come forward. If the government starts sending you out angry letters and slapping you with unreported income penalties and whatnot, then things become a little bit more nasty, and I don't suggest leaving it to get to that point.
How is real estate tax in the U.S. different from Canada?
Well, real estate tax is not necessarily different. They determine a taxable capital gain, although the capital gain tax rates are different in the United States. The way that they tax a property is not much different, except that they have a tax-free exemption that caps at $250,000. So in Canada, you can make millions on your property tax-free. There is absolutely no cap. In the United States, an individual who owns a home by themselves is only eligible to remove $250,000 of that gain. Now, if they're married, that spouse can also have $250,000, so now we're up to $500,000. Now, to qualify for that U.S. exemption, you have to live in the home 2 out of 5 years and have not excluded another home in the last 2 years. So it becomes a little bit different from Canada, where you can't just buy and sell a home every year and get it tax-free. You have to put time in your home for 2 years and have lived there for that period, or used it at least for a period of that year. So it's a little bit less friendly, but certainly it keeps you wanting to sell quicker as well. In Canada, you can spend a lifetime. I know my father purchased a home for $68,000. When he passed, it was worth over $1 million. In the States, that would have created a huge tax. But in Canada, it was tax-free. So in the U.S., you kind of want to sell your home after you've made your $250,000 tax-free and move it into the next one. So it creates movement in the market.
If people living in Canada rent out their secondary homes in the U.S., do they have pitfalls to worry about?
Well, when you're a Canadian and you purchase a home in the United States and it's your vacation home, there is no pitfall. There's no worry. There's no issue. The worry and issue comes down to once you start renting it out, there becomes an immigration issue because there's a chance you might go to collect a rent check or paint a fence or take a job, and then we come into this issue of taking a job away from an American. Now, none of these laws have changed for my whole lifetime. Okay, this is nothing new, but a foreigner is not allowed to enter the United States and take a job away from an American. It doesn't matter what country you're from, nationality or whatnot. And during the Beanie Baby craze, we had some family friends that, got into some issue where somebody lost their job and the person had to go down and work a shift, and because they didn't have their immigration visa, they were in a cell overnight, and it was not a friendly place to be because the American that had lost their job knew that the Canadian didn't have a visa and made a nasty phone call. So when it comes to the real estate, the exact same thing happens. You're in a neighborhood, there's people around that, they want your property. They want to make some money. And if they watch a Canadian down there painting a rental fence, there's a chance they can call the immigration service and create an investigation in where you politely get deported and can no longer enter the United States to deal with your property. So the best thing to do if you own a U.S. home and that you're going to rent it out is have a property manager and always deal through the property manager. You just have to be that step removed. If it's a part-time vacation rental home, the rules become very sticky. You can't just be renovating the full property during your vacation period. It could create major problems. But if you're happy to work behind the property manager, I've got hundreds of clients that have never had an issue. I don't want to scare the pants off of everybody, but you can easily own a home in the United States, quite simply in your name, and rent it out without any issues ever, as long as you don't take the jobs away from the local community that are supposed to get the jobs first.
Peter, how can people contact you and find out more about CENTA?
Well, my website's pretty simple. It's www.centa.com. My phone number, 604-980-0321, or toll free, 1-866-980-0499. My email address is fairly simple, with Peter, P-E-T-E-R, at CENTA, spelled like the website, CENTA.com. I'm available all the time, and I answer my phone during all weird and wild hours because of the international nature. I can't be bogged down to Pacific Standard only here, so feel free to reach out. I like to answer questions.
Peter, thank you so much for being on This Week in Money.
Take care. Have a great day.
My guest has been Peter Ingram, cross-border tax expert with CENTA. He was speaking to us from Vancouver. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Ross Kay, and Peter Ingram, and thank you for listening. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. Now stand by for a company showcase update with Larry Reaugh, the CEO and president of American Manganese.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and president of American Manganese. Welcome back to the show, Larry.
It's a pleasure to be here, Jim.
You're recently back from a trade show in Las Vegas. Have you heard anything back from the people you talked to there?
Oh, that was a couple of weeks ago, and we've been back and forth with a couple of our contacts that we made down there. And what I'd like to do is I'd like to talk about a few things, starting with the fact that the market is still in a spiraling down pattern. And but what I'd like to say about that is it's dropped about 23% since January. I'm talking about the venture exchange. And the commodities have been taking a real whipping. Today was an up day for them, but mostly it's been down for no good reason, and other the excuse that it's got to do with the tariffs that Donald Trump is imposing. But it does have an effect, and the effect is negative on the market. Certainly, all your base metals are way down. Precious metals are way down. And, but that's, to me, that is not a lasting thing. This is not going to be a repeat of 2008. And, even though, the predators are working hard to make that happen, I don't see it happening. There's just too many other things that are happening out there that are positive for the market. Now, I was just reading this morning where, tariffs have, interrupted Panasonic's battery production for Tesla and other customers because they were using some of the material they were getting for cobalt was out of Cuba, and of course there's a sanction on that now. So they have stopped importing from Cuba, but this just shows you that there's a real circle of positive things happening for cobalt. That means that there's going to be less cobalt out in the market certainly in North America. So that's going to make the competition for cobalt much more intense. I don't think cobalt is going to stay down here that long, but again, it's a genuine positive. Now let's go into American Manganese. American Manganese came out with a release this week about where their patents were sitting, and it certainly looks like there's a clear road to having them granted. And we're excited about that. We're excited about the speed at which this has gone through the U.S. Patent Office. And you know, as Norm says, that the novelty of the novel technology is going through the chute quite well, and so novel just means that everything is looks like it's going to be approved. So that's another big plus. We put a press release out on that, and I talked to a big end user of electrolytic manganese metal earlier this week, and they were looking for product. They'd take everything that we had. They need at least 8,000 tons a year, and we discussed the pricing and everything like that. And they said that China is now charging $130 to $136 a pound for electrolytic manganese metal, and that's a way up from where it was some time ago, and certainly a way up from where it was the last several years. It was below $1. So that's a big positive, and we've got interest in the manganese. It's something that I'm giving some serious thought about, and we'd certainly like to see a joint venture partner come along and advance that project. But we don't want to take our focus off of the recycling. This is not a good market for raising money. It's not a good market for a lot of things, and so you just have to husband your resources and keep your eye on the ball. And hey, we got a multi-billion-dollar potential opportunity here for recycling batteries. And again, there's starting to get to be a lot more people that are negative on reuse, because it doesn't make sense economically for the companies to do that. It doesn't make sense to tie up the critical metals for another 3 or 4 or 5 or 6 years when you need them today. And so the batteries are coming loose. There's about 55,000 this year that have reached the end of life. And, that's going to keep increasing as each year goes by. That's a whole business in itself for a company like American Manganese. I always get the question about where are we going to get the product. We've been offered lots of different types of product for recycling, and to do with the smaller batteries used in mobile phones or laptops. And, it's... There's definitely a market out there for our recycling potential. So that is another thing that I would like to point out to people that we have going. But getting back to the sourcing of materials like Panasonic, they don't know which batteries the stuff from Cuba went into. And this brings into mind our recent venture with a company out of London on blockchain, and that company was Circular Limited, and that's basically tracks the cobalt from its source through the batteries in its first life. So I think that we were very opportune in making a deal with them so that we can do this when we start recycling batteries, and I think that a lot of companies will be using blockchain in the future on their sourcing of the batteries, or sourcing of the cobalt material. So that's always a good thing. And the overall picture, is still excellent for AMY's position in this. We still don't know of anybody that is near close to what we've been able to achieve. I can say that with Chemetco, who are probably some of the most brightest scientists I've ever met, they certainly are progressing our project. Without them, there wouldn't be a recycling solution right now. So, we get a lot of sniping on boards where we get written up, but a lot of that is just I don't even want to go there. It doesn't make any sense. Nobody can put down something that's better. They just snipe at your process and your opportunity, and I think that should be ignored by serious investors. So, all in all, Jim, it's been another grinding week, and we can hope for a better August coming up. I think that might be a turning point in the market. So I'm looking forward to it. And other than that, I wish everybody a great weekend, and certainly I'm going to kick back and put my feet up.
Larry, where's American Manganese traded, under what symbols, and how can people find out more information about it?
American Manganese is traded on the TSX Venture Exchange under the symbol AMY. It's traded in the U.S. under the symbol AMY.TSX.V. It's also traded in Frankfurt under the symbol 2AM. We have a website out there that is chock full of information, and that's AmericanManganeseInc.com. Or you can always pick up the phone and phone me here at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thanks for the update.
Well, thanks, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 20th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.